Option trading strategies, particularly Strangle method, is what I am going to explain now with the help of an example. In Strangle strategy, what we do is we buy one call option and one put option. So the question is, a call option on a share with exercise price of rupees 250 is priced rupees 15. A put option with a strike price of rupees 240 is priced at rupees 10. Both the options have 1 month to maturity. Create a Strangle using 3 options. Compute payoff assuming range of spot prices on maturity and illustrate with a payoff diagram. Explain characteristic of Strangle. Now, what we are doing here is buying a call option, buying a put option, and with assumed spot prices, we will calculate what is the net payoff going to be. Now, in the case of call option, the strike price is, exercise price is given to be rupees 250, exercise price or strike price. And it is priced at rupees 15, means it is the premium. The buyer has to pay a premium to the seller, isn't it? And the same premium in case of put option is rupees 10. And its strike price or exercise price is 240. So buyer of call option has the right to buy the underlying asset and no obligation. Whereas the buyer of put option has the right to sell, but no obligation to sell. This basic fundamental understanding we all got. Now, let's say the prices given, strike prices given are 250 and 240. 240. So the spot prices we will take around 2-3 ranges on either side of this middle value of 240. So you take 230, 220, 210, 200, and on the other side 250, 260, 270. Now, starting on with the first spot price, which is 200. Now, firstly, we are going to consider the call option. A call option buyer will exercise his option only when the spot price or the market price is more than his exercise price. Why? Because when the price is more, he exercises at a lesser price, purchases the underlying asset and sells it at the higher price, which is prevalent in the market, and thereby earns the profit, isn't it? So when that is called, that situation is called in the money. When the strike price is more than the exercise price for a call option is called in the money. We write it as ITM. And when the spot price is lesser than the strike price, it is a situation of out of the money, OTM. We call it as out the money. So naturally, the buyer will not exercise his option. He is not getting any profit, isn't it? He only, what is his profit and loss position? He is not doing any transaction, so there is no profit or loss from that thing. Only he will be paying rupees 15 to the seller as premium. So that is the loss which is incurring in this case. Now it goes on up to the value of 250, which is the exercise price of the call option. At that case, when the call option and the exercise price as well as the spot price are the same, They are called at the money, equal, isn't it? So still he will end up paying there is no profit or loss, whether he exercises or not exercises, doesn't matter. But to avoid all the problems, he will not exercise. He will only pay the premium. So incurs loss of minus 15 rupees. Now, when it comes to spot price of 260, there he has got a chance to gain profit. So it is the situation of in the money. He exercises his option and he gets a profit of how much? 260 minus 250 is equal to 10 rupees. Minus 15 rupees of premium, he will end up with a loss of only 5 rupees. When it comes to the spot price of 270 rupees, again, he is in the money. He exercises his option to buy the option underlying asset. And he gets a profit of 270 minus 250 equal to 20 rupees minus 15 rupees of premium. He ends up with a profit of 5 rupees. So this all with respect to the transactions pertaining to the call option with arbitrary assumed spot prices, isn't it? Now coming on to the put option, what is happening when he is buyer of a put option? As I said earlier, he has got the right to sell it, but no obligation to sell. So here, when he will sell when the market prices are less. He will exercise when the market prices are less. He will exercise at a higher price. So he is getting a profit out of it. So it is exactly opposite in position to that of the call option, if you notice. So when the strike price is 200, he is in the money. So he is exercising his option. When he is exercising his option, what is the profit he is getting? 240 minus 200 is equal to 30 rupees is his profit. Minus 10 rupees is the premium which he is paying to the seller of the put option. So going on like that, he is getting profit here also, till the time the the spot price is lesser than the strike price. He is in the money. When both are at the same level, he is at the money, but again he will not exercise. The moment the spot price goes above the strike price, he is out of the money. He will stop exercising. Rather, at the money itself, he will stop exercising and he will start paying only the premium. So his profit and loss comes down to minus 10 rupees only. So this cumulative profit and loss of put option and that of the call option together is the net payoff in this Strangle strategy adopted by this investor. So that is as shown here. When you add up these two, call option profit loss with put option profit loss, you will end up with getting 15, 5, minus 5, like that. Now you trace this. No, you write the strike prices along the x-axis, profit long and loss amount, net profit loss, that payoff along the y-axis, and plot. You will get this kind of a plot. That is the payoff diagram. So with that, I hope you understood the Strangle strategy of option trading.